Hey, how's everybody doing? Mic check. Can you guys hear me okay? Polynesian Pip, aloha. Shaka, bro. How's it going? Canadian Stacker, how you doing? Professor K, good to see you guys again. Seymour Rivers, how you doing? Okay. Yes, if you guys can, I'd appreciate just some feedback on the mic if it's coming in loud and clear enough for you guys. Bonzo22, how you doing? Bonzo, first time I've seen your name. Welcome aboard. Thanks for stopping by. LLD, how you doing? First time I've seen your name also, I believe. So welcome aboard. Vegas Stacker, how you doing? Yes, chill. Sorry about that. How you doing? Welcome aboard. Always Be Funding from Utah. How you doing? Michael B. Truth or Nothing. Professor K again. Silver Warrior. How you doing? Thanks for the feedback. Roberto Minuta. Glad you're here also. Thank you. Appreciate the feedback. Polynesian Pit. Thanks for the feedback. Sean Walker. How you doing? Thank you for the feedback as well. I hope everybody's doing okay out there. I hear Jerome Powell had some kind of a 60 minutes interview today. I was trying to look for it. All I found was some short bit of it. Seems like the same old, but I surely looks like some gray clouds ahead, but we'll get through it. RR, how you doing? Derman Guerrero, how you doing? God bless you also, Derman. Appreciate it. Always Be Funding, how you doing? Troy Rivers, Alaska. How you doing up there? Can silver break the 20 mark in 2020? I think it would. I think it will. Robert Walker, how you doing? Okay, so we'll get ready to get this show on the road, as they say. And again, thank you all for being here. Appreciate it. So hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, and this is our live stream, which we try and get out there every Sunday night, East Coast time, Monday morning here in Asia. So again, we thank you all for being here and appreciate you guys chiming in the comment section. It's good to see you folks here. Daryl Wilson, how you doing over in Hawaii? Aloha to you. Crispy King, John Roylance, a lot of new names. I appreciate you guys being here, and thank you for coming out. John Roylance, thank you. Appreciate that as well. Pink Mangoes, good morning. How you doing? I like that name, Pink Mangoes. It's a good name. Pablo Pena, how you doing? A lot of you guys, a lot of regulars, a lot of new guys. So I appreciate you guys all being here. And as always, don't forget, or please do, subscribe, click on the bell to be notified on updates, and give us a thumbs up if you like what we do. We really do appreciate your support. And you can always find us on social media. Our website is silverbullion.com.sg. We are a gold and silver bullion dealer over in Singapore. Platinum, palladium, also nickel. Nickel, it's a metal used for electric vehicle batteries, and it does have a lot of promise. So we are a bullion dealer out in Singapore. Facebook, Silver Bullion SG. Twitter, at Silver Bullion PL for private limited. If you want just the audio versions, bit.ly, bit.ly/SBTV iTunes, SBTV Spotify. And if you have a telephone app on your phone, do join our crisis tracker group, where we will go ahead and post some information about gold, silver, finance, economics, things like that, just to try and keep us all up to speed. Really, because there's just so much news out there and flying around, and some of it is legit, some not legit, and we try to find what is true and how it may affect us in different ways. So again, we do hope you join us with that that Telegram group. So again, a little bit more housekeeping. Our upcoming guest, I believe this week it's going to be David Stockman, and you know he's going to have some choice words to say. If you follow him on Twitter, he, he doesn't hold anything back. He lets you know exactly what's going on and what's in his mind. And then we're going to have Michael Pinto and Lynette Zhang. So that should be pretty interesting as well. Pinto's always got great info, and Lynette Zhang, I know a lot of you guys watch her, and she has great info, and she really does a good job at helping people out. But next on deck, it's David Stockman, the ultimate Washington insider turned iconoclast. He began his career in Washington as a young man, really a young man, and quickly rose through the ranks of the Republican Party to become the director of the Office of Management and Budget under President Ronald Reagan. So after leaving the White House, Stockman had a 20-year career on Wall Street, and you definitely want to see this interview. So again, do subscribe and click on the bell so we can let you know when that interview's ready to go. Looking at comments again, Truth Teller, that's an interesting one. Truth Teller, goodbye to U.S. dollar, petrodollar, goodbye, silver and gold. Did I understand that right? Petrodollar, goodbye, silver and gold. No, I think silver and gold is going to be doing just fine. Davy, gold almost 1800 USD. Yeah, we'll have to go and check out the price, see where silver and gold is doing. Kirsten Strand, love David Stockman, great. Yeah, I tell you what, I think it's going to be a pretty good interview. Like I said, he doesn't hold back. And I remember last time I interviewed him, I didn't even get to ask the first question, and he already took the ball and ran with it. So Stockman, he has quite a bit to say, and as well he should. He knows exactly what's going on. Very, very knowledgeable guy. RR, yeah, it's appreciate that. It can be a challenge sometimes, trying to get people to come out and come on board, but we appreciate the time that they do give us, and also we appreciate that you folks appreciate that they come on board and talk with us. Viper 99, first time here, welcome aboard. Welcome aboard. I hope we can give you something useful or say something useful or help keep your compass pointed in the right direction with everything that's going on. I mean, everybody's things are just spinning all over the place 360. We need some type of a compass, some type of bearing. So glad you're here. Glad you're here. So one of you guys mentioned gold and silver price, so we're going to go ahead and take a look at that. Let me pull this up. So here we are at our website, silverbullion.com.sg. Let me go ahead and refresh this. Get back up to the top here. In US dollars, silver 1720. Wow, 1720. That is good. Gold 1759. So gold is tracking up as well. Silver and gold doing very well. Nickel, a little bit of a bump. Nickel, I kind of like nickel. I can see a lot of uses for nickel coming up. And again, be sure to download this investor kit, our silver bullion investor kit. We do have some good info there, and one of them, being the why silver. And in that, let me scroll down a bit. In that, we have little bits and pieces about silver: indispensable, scarce, undervalued as money, and probably one of the more important things, a silver gold ratio. Silver gold ratio, excuse me, typically when it's above 80 or 80 to 1, then you would surely want to be into silver. When it's 50 or below, you would surely want to be in gold. So that's something you want to check and make sure and watch. And in fact, let me scroll down here to that ratio. Right now it's at 102. So it's making a move. I think last time we had a talk, we were about 110. So it's come down, which is good if you have silver. It's a very good thing, and it's definitely the time to continue buying silver. And again, if you are interested in any of our services such as storage and storage and things like our peer-to-peer program where you can use your gold and silver in storage as collateral to take low interest peer-to-peer loans. You definitely want to sign up for this. We have personal accounts if it's just you. We have for you and your child. We have for you and your spouse or your partner. We have company accounts, trust accounts, and we even have IRA accounts. So if you have a 401k, you definitely should talk to someone regarding opening up a precious metals IRA account. In fact, you can get in touch with us for that, and we can help point you in the right direction. And as always, we are going to take a look at Twitter real quick. And this one here, let me go ahead and play this clip for you guys. He had some pretty interesting things to say.
You can say that, first of all, what happened in the United States in 1971 is essentially by disconnecting the money from any sort of scarce tether. You can say that, first of all, the reason it happened is the United States defaulted on its obligation. It could not pay. The French sent the destroyers across the ocean to pick up the gold in exchange for the goods. They said, you want to keep buying the goods for IOUs? Send us the real thing. And they essentially called us out. And we had to close the gold window. Otherwise, our gold reserves would have all flown overseas, gone overseas, and we went off this gold standard. This precipitated inflation that wiped out, in the course of a few years, 60% of the purchasing power of the US dollar. And from then on, it opened up the unlimited window to credit creation out of nowhere and money creation out of nowhere. And so when people quibble about we're seeing inflation, we're not seeing inflation, I don't want to get into that subject because these are various measures of inflation. But all I can tell you is that the fact that we have negative interest rates indicate that capital is losing its value. Because what is capital? Capital is some good that you give to somebody for which they pay to use it, right? And the more valuable this capital is, the more they pay to use it. So ask yourself this question. If I'm giving my capital to somebody and I have to pay them to use it, what is happening to the value of this commodity? What is happening to the value of this commodity is it's declining. It's declining, and the declining interest rates and now the negative interest rates are essentially asset inflation. They are indicating that there is more money created out of nowhere chasing a limited amount of real world projects that offer real economic returns. And that is what is happening. And even though we're thinking of it as a bull market, in fact, we are watching capital devaluation, capital being devalued. What we have not seen is the moment of truth. When all of that...
Okay, I'll pause it there. This came out in October of last year, 2019. So he has some pretty interesting ideals, concepts. Gotta give him credit for that. He looks at it in a very holistic type of a way, I guess I could say. Just want to get back to some of your comments here. Truth teller, okay, just to clear up. That clock gold, 23,453 an ounce, and silver 2,829. Goodbye to the U.S. petrodollar. Yeah, petrodollars. I think this year is going to be a very rough year for that petrodollar. Surely next year, also, I believe, is going to be a very, very, very rough year. Let's see what else we got here. RR Bull Pony. Did you guys see his interview with Greg Hunter? Pretty interesting. Bull Pony. He likes to connect a lot of dots, tie up a lot of loose ends, and he'll create his own story, his own narrative. Interesting guy for sure, without question. Let's see what else is out there real quick. Magic Man Powell tonight again said we can print unlimited. That tells us the path forward we are on. And Magic Man, that's exactly why me and probably you and a lot of you guys out there are buying gold and silver, because we know it's more than just the price. Whatever the price does, yes, it has some bearing, but more importantly, the way a lot of us see it is like this. Do you have home insurance? Yeah. Do you have car insurance? Yes. Life insurance, medical insurance, all these types of insurance. You have insurance. But do you have money insurance? And when you bring that concept to someone, money insurance, they will firstly look at you strange. And then when you try to explain to them what money insurance is, because of things like all of this printing And when you explain to them the difference between a market crisis and a currency crisis, and when you go further and explain what a currency crisis entails, how the currency or basically anything in paper that they might have is really going to lose their value. And that's why we get gold and silver. It's a store of value. It's wealth protection. And most of us here understand that. For you guys sitting on the fence, maybe you've been hearing about gold and silver. This is why we do it. One of the reasons why we do it. So again, appreciate that comment there. Let's see what else is out there. Um, okay, let's just go over to see what else that we have on Twitter here. Let me scroll down. Jay Powell from CNBC says a full economic recovery may not happen without a vaccine. Vaccine. All right. Well, okay, Jay. The Fed noted that the recovery likely would depend on how Americans feel about their safety. All right. So if we want to be safe, we're going to have to get the vaccine. I guess is what he's saying. Is he saying that? I'm sure there's going to be a whole lot of opinions for that. Danielle DiMartino Booth, we will see a spike in property tax foreclosures in the coming years. The question is, will private equity backed investors want these homes if they are not certain they can rent them out? And some guy with, I'm not going to say his name, his Twitter name, says we live in an old neighborhood, lots of 5,000 plus square foot homes. I'm not sure if he means, lot and house or just the house. If that's a house, it's a pretty big house. Lots of these 5,000 square foot homes for sale. Most would be sellers are empty nesters. Their property taxes are 20 to 40K a year. And they're finding out they don't have as much wealth to access as they thought they had a few months ago. And this is one of the collateral damages that this what we have going on with the economy right now, where guys, older people, they pretty much are settled. They have their homes, and they're starting to find out that with property taxes and everything else that they may not be able to afford to stand at home. Oh boy, what's that? Canadian Canadian stack donated. Appreciate that. Um, appreciate that, Canadian stacker. Really do. Man, that music scared me. Scared you guys? Scared me. It's a little app that I tried to put in to recognize people, super chats, and when guys subscribe. So scared me. If it scared you, sorry about that. Peter Schiff, President at Real Donald Trump is right. America needs to return to a nation that saves and produces instead of one that borrows and consumes. But the transition will be expensive and force Americans to accept huge financial losses and short term declines in their standards of living. Peter's right. Peter, he's right on a lot of things, and it's he's just a lot of times he's right. Keith Newmeyer, next step is to take cash away. I got denied today buying beer. Would not take my cash. I think Keith Newmeyer, he's still CEO of First Majestic, I believe. If not, someone please correct me if I'm wrong. But I believe he's still First Majestic. Empty beds everywhere. Government's gone crazy. Our rights taken away against our constitutions. Don't allow a repeat of these fascists. Okay, Keith Newmeyer. He's got some pretty choice words. We may have to try and get him on one day. William Middlecoop. What happened after the collapse of the London gold pool? We'll touch on this London gold pool later on. More at the end. But what happened after the collapse of the London gold pool in '68? Well, after that, we did see President Nixon having to close the gold window, and we did see a whole lot of inflation start to come up. And then we saw the birth of paper gold, paper silver a few years later. So London Gold Pool. Maybe we'll do a live stream on that one day. Um, Okay, so I guess a couple more things. Let's see. Hedge fund luminaries are lining up behind gold again. Okay, and then let's see. Central bank buying gold. Okay, so I think that's it. We'll stop there with Twitter. Quite a bit of birds chirping out there with interesting things going on. Got to say, Donald Best. That music was something else. You got scared too, huh? Got me. I wasn't expecting that. Let's see. This is interesting. Powell said we can pay off the debt in a few decades. I didn't read that whole thing. I should have read that whole thing. He's been smoking. Canadian stacker. Okay. Appreciate that. Thank you. Canadian stacker, super chat. Let's see. What do you think is a good weight to hold minimum? I think whatever you whatever you're comfortable with for starters. And I say that because really the last thing you want to do right now is you get your salary, you buy silver, you buy gold, you get your salary, you buy silver, you buy gold, you get your salary, you buy silver, you buy gold, and then if some sort of an emergency should come up, the last thing you want to do is have to sell your gold and silver. So get whatever you're comfortable with. Uh, John Michael, thank you for subscribing. Get whatever you're comfortable with. Um, for me, I've said this before. I try to have 3 to 6 months worth of salary in gold and silver, and the reason is I do believe there is going to be a transition. We're here with the current monetary system. We're going to move over to a new monetary system. It's in between this transition. This is where you want your wealth protection. These are the things you want to have to get you through the transaction. The things you want to have being things like gold and silver. So for me, it's at least 3 to 6 months salary worth, but you also want to make sure you have enough with you for opportunities because in that transition, like we're seeing now, businesses may go bankrupt and it may be a business you want to buy, which, unfortunately, there are circumstances, I mean, unfortunate for them, but it may be an opportunity for you. Or people may have to, like I just showed, these property taxes may be so outrageous they may have to downgrade on homes. So there may be bargains on homes out there as well, where if we have this market crisis and it rolls over into a currency crisis, these people selling homes and businesses, they're not going to want to be selling it for fiat anymore. They're going to be looking at something else that has value. Um, so again, for me, at least 3 to 6 months of salary in gold and silver, and then you want to have some for opportunities. And if you are wealthy, I will say, or if you can, store some outside of your jurisdiction. Wherever you live, store some outside of there. If you live in the States, store some gold and silver outside. If you live in Europe, store some gold and silver outside of Europe. And that's where a place like Singapore, which does have a friendly jurisdiction as far as being able to store gold and silver and things like that. You want to look at a place like Singapore. So it all depends where you're at, what level you are on. But for starters, I would say 3 to 6 months. Great question indeed. Let's see what else is out here. LLD, exactly. Always good to have emergency funds if you can, and you don't want to use your gold and silver to. You don't want to have to sell that to get emergency funds. It's a painful feeling. I know a lot of you guys out there had to do it. I've had to do it a few times, and it's very, 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 very painful. So one of the things, of course, that caught my attention this week, and you folks all know about it as well, was, or last week anyway, was we saw the Fed make a statement. It went something like this, where the New York Fed announces the start of a certain secondary market corporate credit facility purchases on May the 12th. Okay, so let's take a look at what this thing is all about. So this is coming out of the Federal Reserve Bank of New York. So as specified, hang on. New York Fed announced the start of certain secondary market corporate credit facility purchases on May 12th. So, okay, they're going to begin purchases of exchange traded funds or ETFs, corporate ETFs. And as specified in the term sheet, they may purchase U.S. listed ETFs whose investment objective is to provide broad exposure to the market for U.S. corporate bonds. Corporate bonds. The preponderance of ETF holdings will be of ETFs whose primary investment objective is exposure to U.S. investment grade corporate bonds, and the remainder will be in ETFs whose primary investment objective is exposure to U.S. high yield corporate bonds. The SMCCF will consider several additional factors in determining which ETFs will be eligible for purchase. Those considerations include the composition of investment grade and non investment grade rated debt. Doesn't this sound like the CDOs back in 2007, 2008, where you had all that junk mixed in with the good stuff? Well, this time the Fed is buying the junk mixed in with the good stuff. I guess they're trying to shield. Fed is definitely trying to shield the banks in some ways. So, and there's no question to that. Anyway, investment grade rated debt, the management style, the amount of debt held in depository institutions, the average tenor of underlying debt, the total assets under management, the average daily trading volume, and leverage, if if any, leverage if any. Okay, so that was one thing that caught my eye last week, for sure, and all of you guys are familiar with that. No question to this again. But in basic English, the Fed, they're simply saying, as mentioned, their objective is to provide broad exposure, which ETFs are going to do, to the market for U.S. corporate bonds. So just for all of us to get on the same page with these corporate bonds, in simple terms, when the company is looking to raise funds, they generally will do two things: issue, sell bonds; issue, sell stocks. Difference being with stocks, when you buy stocks, you're buying a share, part of an ownership of a company. When you buy bonds, you're really making a loan to the company, which is why these companies have ratings, triple A, triple B, whatnot, which is why they have ratings. And you get paid that money back at the maturity of the bond, but along the way, you will also get paid interest. So really, the in general terms, the difference is when you buy stocks, you're buying ownership into a company. When you buy bonds, you're basically loaning a company money based on a rating, and you look to get interest payments. So that's generally the difference, the easiest way to say the difference between the two. But it's important to note because the Fed is going to be buying corporate bonds. So what's left for a company to raise funds? Generally speaking, stocks. What's left is stocks. So this is why all the chirping that we hearing of the Fed perhaps having to go into the equities market, having to go into, let's say, buying stocks. It's critically important because if they're already buying bonds and then they're going to be buying stocks, even if it's ETFs, even if they're using special purpose vehicles, which would be like BlackRock to go ahead and buy stocks for them. That's the end of the market. It's the end of the market. Fed is buying stocks. Fed is buying bonds. That's the end. Stick a fork in it. Capitalism. Capitalism is dead. It's dead at that point. And if capitalism is dead, what ism are we headed to? It's capitalism. What other isms are there? Where are we headed? So, nonetheless, we're going to go ahead and take a look at some of the reactions because I think probably what's getting more important nowadays, it's not so much what the Fed is going to do anymore because we kind of know they're just going to throw money all over the place, just blast their money on every wall. But I think what's getting to be more important is people's reactions, where you see some guys who say this is good, some guys who say this is bad. So for now, I want to take a look at your reactions and your comments with what you're having to say out there. Let's see. Man of action. Bonds are corporate debt. Stocks are corporate equity that doesn't get paid until after the debt is paid It's it's really I think you said it pretty good. I can go with that. I'll go with that for sure. No point. I'll go with that. I'll absolutely will go with it. RR, capitalism is dead. Along with liberty, it's getting there, my friend. Um, Getting there, and I'd say it definitely started decades ago with crony capitalism. That was the link between then and now. When all that crony capitalism in between, and that's these things are coming back now, without a doubt. Without a doubt. Let's see. Victor, Claudio, capitalism isn't dead. Free markets are dead. Okay, that's a good point. It's a good point as well. It's a good point. Okay, I'll buy that. I'll buy that. You guys are good. You guys are doing pretty good tonight. Pretty good this morning. Okay, so we have that, and so I want to go and take a look at yeah. Let's see. So we're here. So I want to go ahead and take a look at an article that came out. Let me pull it up for you guys real quick. Hang on. Okay, so this is from Market Watch, and the Fed kicks off buying of corporate debt ETFs. So Fed purchases of corporate debt ETFs is focused on the investment grade market, focused but not entirely investment grade market. Federal Reserve is finally kicking off its purchases of corporate bond exchange traded funds on last week, marking the beginning of its historic intervention into a market that sits traditionally outside of central banks' influence. Purchases are aimed at supporting the flow of credit as corporations look to survive the hit from the bug, which has upended supply chains, hammered consumer spending, and put millions out of work. Since large businesses often rely more heavily on corporate bond markets than banks to borrow money during times of crisis, the Fed's action looks to arrest financial turmoil that reared up in March and limit the economic fallout from the bug. We'll take a look at what that headline or link was a bit later. Now, under the emergency lending programs authorized by Congress, the Treasury Department is allocating 75 billion equity to the Fed. Okay, these are just the numbers part. Um, it's akin to borrowing $10 for every $1 invest. Okay, a chunk of these funds will be dedicated to purchasing ETFs focused on the investment grade corporate bond market, with the rest of the funds left for ETFs in so called junk bonds or debt rated below investment grade. Fund management giant BlackRock was tapped to run the emergency lending facility on behalf of, of the Fed. I just want to add something with BlackRock. I did see some articles saying where they have a 2 week cooling off period because they're investing for the Fed, or may not be the right word to use, but they have a 2 week cooling off period, and then they can go ahead and invest as well personally. So I mean, let's just say if you're handling the account for the Fed, and you know where you're putting money and whatnot, you got to wait 2 weeks, and then you can go ahead and enter the market and do what you want. They call it a cooling off period. So they are truly going to know a lot of things that only insiders things that only insiders would know. So BlackRock, I think we're going to have to watch them as well. So the Fed is going to buy ETFs. What does it mean? Central bank is acting as a buyer of last resort and propping up the bond market in the most efficient manner possible. Federal Reserve last week announced fresh round of stimulus designed to calm the markets and buffer the hit to the economy from the bug. Among other steps, the Fed said it would buy exchange traded funds that track the corporate bond market, a first for the US Central Bank. This will provide much needed liquidity to the bond market and to ETFs. Financial markets have been pummeled over the past few weeks. The global oil market has been collapsing just as a virulent bug travels throughout the world. sapping resources and shutting down economies. Investors across all kinds of markets are racing to sell everything. But the dysfunction may be particularly acute in the market for more highly rated corporate bonds, which are not as risky as high yield or junk rated bonds. Investors are not used to contemplating such a massive wave of defaults and bankruptcies as the one that might be upon us, as companies from cruise ship operators to oil pipeline operators face zero, near zero cash flow, which reminds me of one more article from Twitter I want to get down to. And don't forget the WHO, the World Health Organization, giving us great medical advice. They're telling us that Europe should prepare for a hot summer. Yeah, those doctors at the WHO, they're always on the ball, right? And that's a good medical advice to know. Prepare for a hot summer. Thank you, WHO. Okay, sorry about that, guys. Just had to kind of throw that in. But this is the article here. Delta will retire its iconic Boeing 777 fleet due to the bug. Airline just finished a 100 million project to modernize the plane's interiors, and they're basically going to just park the planes on the runway, and they're not going to use it. And it's really because international flights, they're just not going to be there the way they were. So this article, since we're touching a little bit about bonds, corporate bonds, Delta will retire its iconic Boeing 777 fleet because of the bug, an unexpected end to the airline's pioneering flagship. So it plans to retire its fleet of Boeing 777 aircraft by the end of this year, according to the CEO. Decision to retire the long haul plane. And that's the key. The long haul plane comes as airlines plan for a sluggish return of international travel demand. Delta has temporarily parked about 650 aircraft due to the bug. Can you believe that? 650 planes just out there, sitting there. Their CEO, Delta CEO Ed Bastian, said last week that the airline would retire its fleet of wide-body jets by the end of this year. Again, this is the Boeing 777. In a memo to the airline's employees, Bastian said that the decision came as the airline was striving to reduce cash burn amid the bug. The full memo is embedded below. So these are the types of aircraft that looks like they're going to be parking. As international demand returns, the 777 will be replaced. So it may not even come back. It's going to be replaced by newer Airbus A330s and A350-900 aircraft. Bastian said that these aircraft, they burn 21% less fuel per seat than the 777 aircraft. So that's, I don't know, man, that's pretty astonishing. They're going to basically let a fleet sit out there, and they're going to buy new planes. Going to buy new planes instead. So, I mean, I guess it's nice to have money from Uncle Jerome, huh? You can pretty much do whatever you want to do with it, if that's the case. Anyway, let me get to some of these some of your comments here. Okay, John Michael Karma, yeah, that's exactly where they're going to be storing them in the desert. And again, thank you for subscribing. I appreciate that. Okay, let's see. Professor K, okay. Let's see. Okay. So, all right, let me get back to this schedule. So what I want to do is take a look at some of these reactions that we've had from pundits. And it's pretty interesting because some people say this whole corporate bond ETF thing, it's a good thing. Some they can't believe it, but I'll play a few reactions and we'll just go through them and maybe have a little bit of fun with them.
The Fed making history today, and for the first time ever, began buying corporate debt ETFs. The unprecedented move driving an explosion in the corporate debt market.
So again, this is from
$910 billion.
CNBC.
That's how much corporate debt has been issued this year alone, and that is up 92% from a year ago. And get this, according to a new survey by Bank of America, corporate bond investors are now the most bullish they have been since 2006. So with the Fed officially in the market, is it now the time to sell that debt? Guy.
I'm not a bond person, as you know, and the short answer is probably no. I mean, if they're going to backstop things and as vibrant as the market seems to be, you probably got to hold on. But with that said, you know where I stand on this, and I think it's ridiculous that they're going down this avenue. And the next stop is probably going to be individual equities at some point, which is really ridiculous. I'm a big believer in corporate Darwinism. Allow it to manifest and let the chips fall where they may. And the Fed is just taking price discovery out of the equation. So as much as I'd like to say sell into the Fed, I mean, the old adage, don't fight them, probably holds true in corporate bonds as well.
Okay, corporate Darwinism. That's a new word for me. I like that. Gonna have to use it. Gonna have to use it sometime. Yes, fire sale on 777. I'm watching your comments go by. So that was on the side of where it's not a good thing. Corporate Darwinism, survival of the fittest, right? So now I'll play a clip on the opposite side.
I mean, I think what the Fed has done is just absolutely brilliant. Just
Again
by
from
saying
CNBC.
we're going to do this in the future. They announced this in March. They didn't even get started until today. And yet this sort of instantaneous healing of the corporate bond market is really extraordinary. You talked about those issuances. Those are gigantic numbers, which also helps the banks. I mean, you have Citi and JP Morgan and Bank of America. I mean, their capital markets desks have not been this busy in years, so that's good for them. But I think it's a bit of a buy the rumor, sell the news, in that we don't know exactly how they're going to be putting the money to work, right? We know it's up until September 30th of 2020, although it could be extended. The first phase is going to be their biggest phase, what they call the stabilization phase. But in my view, stabilization has already happened. And we're not going to see, maybe once a week, we might see an update on what they've bought. And I don't know that they really need to put it all to work. It's successfully, they've been successful in what they've tried to do, which is stabilize the credit market. So kudos to them. I don't know how they get out of it, but maybe they can just go slow for a while and kick the can down the road.
Yeah.
I don't know.
Okay, so they've been successful in stabilizing the market, but she doesn't know how they're going to get out of it. Maybe kick the can down the road is what she's saying. Well, maybe that's what they've been doing for the past decade and beyond. So two interesting points of views there. So let me take a look at some of these comments again. I saw one here. Let's see, where'd it go? Okay, Lord Humongous. Where's gold at on the Asian markets? Let me go ahead and take a look again where gold is for you. Gold right now. Hang on, let me refresh this. So again, this is back on our website here. So gold right now, we're at about 1759. I mean, it's good that it crossed the 1750 mark. It's good that it passed there. Silver still holding in the 17 range. Looks to be pretty firm right now. So we'll see how it goes the rest of the day. So those were two opinions. But again, the more interesting one I found was the second one where she says the Fed has done a good job at stabilizing the markets. Where she says, but I don't know how they're gonna get out of it. Maybe kick the can down the road. Pretty odd. So I'll play another reaction from another pundit.
Buying corporate bond ETFs, that was a surprise. What does this mean for the ETF community, Dave?
Well, obviously, it's a good thing. It puts some buying pressure under what has been the most pressured part of the market. As much as we've been talking about what's going on in equities, what's gone on in bonds here is really unprecedented. And so seeing the Fed make this move is also unprecedented, but not necessarily unexpected. After all, we have plenty of examples of other central banks doing things like this. The Bank of Japan has been steadily buying ETFs in that market for going on 6 or 7 years now, to the point where they now own 80% of the issued ETF assets in Japan, about 5% of market cap. Now, most of that's been focused on equities, but I think we'll see something like that here in the U.S. My hope is that they participate broadly in the market, not just in ETFs, but across the bond spectrum.
Okay, so there's another opinion. I'll get to one more opinion. Just a couple more comments here. I want to answer. Best reply. Yes, Boeing 777 No, it's a Boeing 777 for sure. Just want to let you know that we saw your comment sneak in there. Kirsten Strand, I still can't wrap my head around how the bug is affecting our reality and economy. It's been pent up. We've some guys have said, and I agree with their analysis, where they say when you go back to 2007, 2008, stock market was at around what, 5,000, 6,000 points, somewhere around there, seven, somewhere around there. And a lot of guys feel that it needs to get back down there, because what happened after that was we saw QE, we saw the Fed jump in, and markets rose. And I don't know if you can call that a recovery, because basically it's like cheating. I mean, it's like you're gone, and somebody stuffs some money in your pocket and says, okay, try again. Keep going, keep going. It's almost like cheating in a sense. But I guess in the world of finance, that again, that's just how things go. But a lot of guys feel that it needs to get back down to that 8,000 level, 7,000 level, and then we will truly have a washing and a healing. So it's a long ways to go, long ways to go. So great point, Kirsten. So let me I'll play one more reaction, and I think this one is from Jim Bianco, who we've been really trying to come on the program, but he's always got some great info and good words to say.
Our next guest says the Fed should not be buying corporate debt. Let's bring in Jim Bianco, Bianco Research. Jim, why not?
I think that they're opening up a can of worms, and just a little nuance in the conversation before. The Fed started buying bond ETFs today. They haven't yet started buying corporate debt. That's still another ways away. They've got some operational issues they've got to work out, but they've also promised us that they will do it. There was, as Karen said, a massive announcement effect on it in late March when they made the announcement that all the debt markets turned around and opened up. It allowed a lot of companies to issue bonds in order to replace their credit lines that they were drawing down on. But the Fed is not going to then walk away after the announcement. They're going to keep buying. But today was a watershed day in that they bought ETFs. Now, the big problem is, I think that they've got twofold problem. One, how to get out of it is going to be a big problem for them. I'm not even sure how they even end it at this point. I know September 30th is a date they're going to end it, but technically they need the Treasury's approval to do that as well, too. They need the Treasury's approval to change these programs in any way. 5 weeks before the election, the Trump administration is going to say, no, you don't have to keep supporting the markets anymore. So, of course, that's going to get extended and then extended and extended. And so they're opening up. They may have solved a short-term problem in March and April that the markets were being dysfunctional. But as Warren Buffett said, there might be extreme long-term costs to this as we go forward from here.
Okay, I just want to give one more part of Jim Bianco.
Well, one long-term cost, Jim, obviously could be, in terms of short-term solving the problem, you're solving the short-term liquidity problem. But as we get out of this pandemic, we might have businesses and consumer behaviors that change fundamentally, and you may have a solvency issue on your hand, and all of a sudden the Fed is holding the bag there. I mean, is that what you mean by the problem is how does the Fed get out of this thing?
Yeah. Well, I think that there's two problems that the Fed's going to have. First of all, is the solvency issue. Now, the way the market is thinking about this, and let me use some of the examples like Six Flags or Carnival Cruise that has raised a lot of money, is they've raised enough money through the debt market that they don't need to have any revenues till next summer. And then the argument is by the summer of 21, they should be restarted at some point, and then they can pay off that debt. And the bondholders, knowing the Fed has got a backstop, which is a big thing, that's why you've got the most bullish since 2006. The underlying theme there is, of course, I'm going to be bullish on the bond market. The Fed is behind this thing and making sure it's going to be together. So why wouldn't I buy it? So you buy Carnival Cruise, you buy Six Flags on the idea you can get them through to next summer, and then they can restart. So if that's an assumption that we'll have to see whether or not that actually works. The second problem the Fed's going to have when you start getting into corporations is you have the potential of a restructuring. You have the potential of having to make a vote on how to run the business. They desperately don't want to do that, but they might be forced into those types of proxy battles or types of restructuring type of votes that need to be happening when you own less than investment grade junk on a bond, a company that needs restructuring. So they're going to have another issue with that as well, too.
Tim, you got a question?
Okay, so Jim Bianco is always a great guy to listen to, and I appreciate the thumbs up. Thumbs up absolutely do help us a lot. So again, probably one of the bigger takeaways. Jeon is thanks for subscribing. Appreciate it. I think someone else also subscribed. I missed it, but thank you as well. But I think the point here is, it's a little bit of cheating. I guess I don't know how else to say it. When the Fed is pretty much holding up the markets, you know what the Fed is going to do. Just jump in and go for the ride. You know that they're going to be supporting you. So it's I don't know how else to say it. Maybe cheating is not the right word, but it's definitely Fed induced, and just follow along and go for the ride. But the other point is, how they're going to get out of it. Nobody really seems to know right now. So again, looking at these comments, you guys are out there. You got some pretty good comments, and say bye to some pretty good comments out there. Let me see if I can jump in on any of them. Let me see real quick. Let's see. Okay. Let's see. Magic Man again. Silver 80 is coming. Just timing is question. My guess is within 8 months. 80 ratio? Are we talking about going down to the ratio 80 or $80 per ounce? That'd be pretty cool too. Let's see. Okay. Yeah, ride the curve. How a bug took down an airline industry. Go figure. And I mean, because this was coming all on the back of the best economy ever, so to speak, and all these companies were making money, and then the prices were going up, and then you hear things about buybacks and whatnot, and everything was supposed to be great. Everything was supposed to be great, and then this little bug comes along, and it's done some damage for sure. I'm never gonna make light of people who actually got affected by the bug, but that's one part of it, and yeah, music just went off. Larkball. Sorry about that. It's getting kind of mixed up here. Larkball, appreciate it. Get up there, silver. Yes, absolutely. Let's hope it goes up. I'm hoping it goes up, but I'll be honest with you. When it goes up, sometimes I'm waiting for it to come back down because I need to get more. So, it's you want it to go up, but at the same time, you want to make sure that you're still able to buy and keep going, and you don't want it to run away too much. But yeah, would definitely love to see it go up. Phil, thank you for subscribing. Appreciate it. So, that's one of the things with the Fed, or the questions right now coming out is, how are they going to get out of this? Camfu too, appreciate it. Thanks for subscribing. How's the Fed going to get out of it? Because, when we go back in history, well, let me back up. There are some people who say this is a good thing, and some say it's not a good thing. But one thing in common pretty much is, as I said, how is the Fed really going to how are they going to get out of this? And we've heard guys, we've heard Powell, we've heard Kashkari, we've heard various Fed heads sounding pretty confident, maybe overly confident. Some guys even a bit arrogant. Saul Doglio, thank you for subscribing. Maybe even a little bit arrogant, which is why I need to throw this out there and remind us just how the Fed thought they could have unwound before, and it's the same how they think they can do it. Maybe I think they said a decade or something away. I could be wrong, but I'm trying to remember what Jerome Powell said. But there was another Fed chairman who said that they could definitely unwind.
And the gentleman from Texas, Mr. Powell, is recognized.
I thank the gentleman for yielding. I imagine everybody agrees that the increase in the monetary base in this last year and a half is probably historic. I don't think we have much in our history to look back at as a precedent. So I would assume that we can't look back too easily and look at trying to solve a problem like this and what we have to do and how much the monetary base has to shrink. As we talk about this, I think most people assume that they're waiting for a signal from you when the balance sheet might shrink. But you know, even in the Depression, when it shrunk 16%, it wasn't done purposely. You know, it was the way the system was working back then. Can you give me a rather quick answer on this? Do you have any idea what percentage the base should shrink or might shrink, or is that something that you don't even want to address?
No, I think we would like to bring the balance sheet back to something consistent with where it was before the crisis, which means enough to accommodate Americans' demand for currency, plus a modest amount of reserves in the banking system. $1 trillion, I think, would be
$1 trillion?
Or less, yes.
Okay, of course, that would be very unprecedented.
Okay, sorry about that, guys. Lark Ball again, thank you, appreciate it. New subscribers, I appreciate it as well. But what Bernanke was saying was he expects to go back under $1 trillion, and the Fed thought they could bring the balance sheet back under $1 trillion, have enough money in reserves, and enough to accommodate the demand for currency. It's a decade later. Okay, it's a decade later, and we're still going in the opposite direction. The Fed has pushed the punch bowl to Wall Street. It's pushed it to Main Street via helicopter money. And it's pushing the punch bowl to the Treasury. When all this money, loans the Fed is giving, when all of these things default, who do you think becomes the owner? Is it even possible for the central bank to own so much of corporate businesses, of loans that have gone out? Is it even possible for your bank to basically, what do you say, own the country? Is it even possible, right? So, again, this is something I don't know how much we think about, but again, it's another reason why we're out there buying gold and silver. We need to understand that, the way things are going right now, it's not just whatever happens within, let's say, the U.S., Europe, Asia. I'm sorry, I always, it's always U.S., but we got to consider Europe and Asia as well. And I think more or less they're going to come to the conclusion that they've had enough. I think they're going to wake up more to what's happening, meaning more than most Americans will. They'll probably see it first, wake up first, and make the right moves first before the rest of the U.S. does. And so for you guys who are in the U.S., I think you folks are far ahead of everyone else. For you guys in Europe and Asia, I know you're watching all of these things unfold, and I know you got things you need to take care of in your own countries with your own central banks, but you guys see it. Everywhere around the world, there are people who see it, and that's a good thing. That's a very good thing, especially because things like gold and silver, it's known all throughout the world. So it's not just some currency that may get in trouble, or and then what do? This is something that it's known throughout the world, gold and silver. So that's another thing it's another reason why we buy it. We know that it has value all over and anywhere in the world. So we have some of these analysts. They're for what's going on. Some guys they're not for what's going on. And then I just want to pull up this article from David Rosenberg. Let me share this with you. He says that these bulls are in a fantasy land, and you know what? I'd have to agree, because if the Fed does not intervene, there is the markets would not be where they are today. So this came out from a presentation, based on a presentation from John Maldine's 2020 Virtual Strategic Investment Conference, which is being held from May 11th to 21st. Okay. So David Rosenberg, you know what? I'll make this a little bit larger. I think the text might be a bit small. So let's make sure we all can read this. David Rosenberg bluntly told attendees last week at John Maldine's Virtual Strategic Investment Conference 2020 that the stock rallies in recent weeks ignore reality and don't recognize that the U.S. is likely entering a depression, facing double-digit unemployment for at least 3 years. Secular changes in consumer spending and saving, and deflation followed by stagflation. Right now, I would classify the equity market as exhibiting a level of hubris that is as amusing as it is disconcerting, said Toronto-based Rosenberg, who in January started his own economic consulting firm, Rosenberg Research and Associates. Okay, we'll move on. We are in the Great Repression, and the downside risks brought on by the bug are not being factored in by a lot of people, he said. Seriously, fully 80% of the stock market rally since the end of March has taken place on the days of the 7 worst readings on initial jobless claims of all time. Let me read that again. 80% of the stock market rally since the end of March has taken place on the days of the 7 worst readings on initial jobless claims of all times. Yeah, that's when you really want to invest, when you see jobless numbers going up, right? So, again, just being a bit sarcastic here. So he's right. He's correct on this. It's surreal that we got that huge rally on Friday following the payroll figure. U.S. Labor Department reported Friday, May 8th, that 20.5 million non-farm payroll jobs were lost in April, catapulting unemployment to 14.7%. But Rosenberg maintained the loss was actually 27 million jobs when you account for the big drop in the participation rate and the errors that people made in classifying themselves erroneously that they're still employed when they're actually not. The real unemployment rate is currently over 20%, as if the reported 14.7% rate isn't horrific enough. We are likely going to see another 5 to 10 million jobs lost this month in May, and the unemployment rate will probably test 30%, which we last saw in 1933. These are Great Depression numbers. So, on one hand, again, you got people who, everyone has opinions. Some people see things this way, some people see things that way. The way I look at it, as I mentioned, the Fed intervened. Had they not intervened, the market was back at about 6,000-7,000 points back then. That's the starting point. That's where it needs to go back to, or that's where, if it does go back to, then okay, I would start to believe what's really happening in the market. But as long as we keep seeing this Fed intervention, Fed throwing money all over the place, they open up their toolbox. Only tool they have is printing press, printing machine. That's it. That's the only tool they have. Everything that they've done relied on that printing press, and that's it. That's it. There's nothing more that they have. So again, looking more at these unemployment. Looking more at these comments. Sorry about that. Let's see. Ken Locke. Greed is so blinding. When our children are made slaves, what is it we should tell them? Ken, tell you what, it's. I think we are at that fork in the road. Where we need to decide what we're going to do. We're seeing central banks do things that they've never done. We're seeing markets doing things that they've never done, and following a market crisis. I don't think it's out of reason to expect a currency crisis. If these two things should come into play, yeah, we're at that fork. If these two things come into play, where are we headed to? As I've said before, what ism are we headed to? So let's see. RR, yes. Correction, they don't even have a printing press. They have a keyboard and electronic digits. That's true. I think even Jerome Powell, he said we don't print money. They create it digitally. But then he backtracked a bit and then he said something along the lines of we do print some money. So he's but you're right, RR. It's almost all of it is digital. And again, that's why we've also said before where when it comes to cash, there's only so much physical printed cash. The rest is digital dollars. And that's why a few months back we saw a lot of family offices. What their clients wanted was cash. They wanted to hold and have physical cash. And I've come across a lot of stories pertaining to that, and more than likely it's because there are only so many physical dollars printed as opposed to digital dollars. A lot more digital dollars out there. So you having the cash is it's not a bad idea. Especially if things really start to light up a bit. But again, that's why we have silver and gold, right? So going through some of these comments again. Excuse me. Let's see. Yeah, RR again. True. The Fed has created, excuse me, so many distortions in the market. There's no way to tell what exactly is going to happen. It's chaos, chaos. That is true. So let me get back to where we are. So that was Rosenberg. Sorry about that. Let me get to there was something that Michael Pinto also said. I want to get to what he put out in his website, one of his posts. V-shaped recovery will need Viagra. So Pinto, he doesn't buy it either. What's going on? His clients have known for a long time. Let me make this a little bit bigger again so we can all see. Have known for a long time that the nucleus of the next crisis will be in the over-leveraged corporate bond market. Let me see if I can find the date on this. I know it was a while back, not that long ago, but I think he wrote this before all of these things happened. But anyway, this notion was confirmed recently in an article from Wall Street Journal. Companies that borrow in the junk loan market are now in a far weaker condition financially than they were prior to the Great Recession. Borrowers with loans Moody's Investor Service rated with the worst rating in the junk debt category, B3 or lower, or where's our Boeing 777 guy? He's going to say something about this. Made up 38% of the market in July compared with 22% in 2008. Bank of America calculates that the 29% of outstanding leveraged loans will likely default in the next credit recession. 29% of outstanding leveraged loans will likely default. So again, from WSJ, CLOs, collateralized loan obligations, which we talk about often here, are highly susceptible because they use borrowed money to buy leveraged loans, boosting the yield and the risk of the investments. CLO managers issue bonds to buy bundles of leveraged loans, then use cash flow from the loans to pay interest and principal on the CLO bonds, pocketing the difference. When downgrades and defaults mount, CLO managers stop making payments on their most junior bond, prices plummet, and the market for new CLOs shuts down. The soaring amount of distressed debt is simply reflecting the economic plunge taking place right now. For example, the Empire State Manufacturing Survey saw a record decline to minus 21.5. The Philly Fed survey saw new orders plummet to a record low as the overall index fell to minus 12.8. Initial jobless claims are a record high, 3.3 million, and the market services PMI registering a dismal 39.1. And anytime we're under 50, it's trouble. Well, here you go. Whereas 49.9 would be recessionary. These data points all indicate that the depression has begun. How long this lasts depends on the bug place curve. Depends on the bug place curve. So that's coming from Michael Pento. We're going to have him coming up. Someone we also just had was Luke Groman, and I'm going to play a couple of clips from last week's interview that we had with Luke because there were a couple of things that kind of stood out. Also grabbed my attention, and I'll get into that shortly. Just want to take a look at comments, and then we'll go ahead and take a look at Luke Groman's comments. Alan Eng, thank you. Just subscribe. Thank you. Appreciate that. And again, appreciate the thumbs up. Thumbs up are probably the least painful, biggest thing that you could do for us. Thumbs up. They really do matter. They really do count. They really do help us probably more than anything else. So appreciate these thumbs up. So take a quick look at these comments again. RR. Powell only wears the purple tie now. Must be super glued around his neck. Hey, maybe I've noticed that as well. I think he just wears one or two. I think different ties. So yeah, that's Jerome Powell. Okay, so let's see. Viscount Murpheus, let the free market economy work this thing out. Yeah. I mean, there are some guys who feel, the Fed needs to save things, and then so it can buy us time, and we can reorder, restructure, rearrange, and redo things and get them back on track. Other guys feel, what, just let it go, let the chips fall where they may, and we'll recover, a real, genuine recover, and move on. But in the middle of these two are the people. People are going to get hurt. Quite a bit of people are going to get hurt. I mean, I think it's a tough call. I mean, the idealist in me, says, let's start over. I mean, let the chips fall where they may, and we go from there. The realist in me is, there are people going to get hurt. Maybe you don't want to hurt people, so try and do what you can. But even within that realist concept, eventually it is going to end. It's going to unravel, and it is going to end. And again, this is why we need to help people to understand about gold and silver. And again, I say this often. You guys out there with your comments, guys who are on the fence or who are new to gold and silver, they're watching your comments. They're reading it. I might say one thing that might get them to open up to it, but it's really your comments. And for that, as I always say, I appreciate your comments, because that is the other thing that can really help people, is when they see what other people feel, what other people think. You're going to help them more than I ever could. So again, appreciate your comments. Try and help out as much as you can. Help people to understand. It'll definitely go a long way. We say this before, be a blessing, not a burden, right? So let's help out as many people as we can. But getting back to Luke Groman, I'll play two clips. I'll start off with this one from the interview we just had.
When you're running leverage as high as this system was running leverage, and I think it's important too, 2000, we had a stock bubble, it popped, and we kicked the stock bubble up to the banking system by creating a housing bubble. And then it popped, and we kicked that problem upstairs to the sovereign level by basically increasing sovereign debt around the world and to very high levels, highest since World War II. And now we've had this pop. There's nowhere to kick this upstairs to. Well, there is. They have to kick it upstairs to the currency, basically. The central banks have to basically create whatever currency is needed. Otherwise, we have our first global. I think effectively what we're seeing is the first global sovereign debt bubble in 100 years was burst by COVID.
Okay, so Luke Groman is, he's talking about the markets, and then he's talking about how it's going to go to another level from the market crisis. So for me, the way I interpret that, this is not Luke's words, but the way I interpret it is a currency crisis. That's how I interpret it. It's my interpretation. I'm not putting words in Luke's mouth. That's just how I take it. It's going to move from a market crisis to currency crisis. So my opinion, not Luke. Okay, so that was one thing he said that I found pretty Pretty interesting. And I'll play one more clip with something else Luke said.
The way I've thought about it, of your question of is there a region that will be safe, or I think it would affect the whole world. To me, what it comes back to is it's why gold seems so clear. Gold and Bitcoin seem so clear as assets. Is I can't tell who's going to go over that cliff first, but I know it's looking increasingly likely now with the COVID crisis that at least one of them is going to go over that cliff. And once one goes, they all go. And I don't. The reason why I like gold so much and Bitcoin as well is I don't have to be right on the order. They're running neck and neck. I can just move assets into gold to Bitcoin, and that's to me where I think ultimately the safe haven is going to be. Because if we go back to what we talked about earlier, there's either going to be a chaotic collapse, in which case gold's going to do really well, or the central banks are basically going to have to buy in much of the global debt market, and gold should do really well too. And so gold and Bitcoin are really the only assets that we see that do well regardless of whether the central banks stave it off or they don't. And everything else has sort of binary outcomes. It either does well before but bad after a collapse, or it does poor before a collapse but really well after. Gold and Bitcoin don't really care the outcome. And so I like that positioning.
Okay, so notice how Luke mentioned the market crisis and then went into currency or sovereign crisis, right? And then we have talked about this before, where market crisis is different from currency crisis. And when markets go bad, there will be bargains to buy with your cash, with your fiat. But when a currency crisis hits, cash may not do what you expected or wanted to do once there's a currency crisis. So this is why you guys know what I'm looking at is cash for now. With the market crisis, there are going to be things you can do with it. And many of our guests have said there is an expiration date on cash, meaning when that transitioned over into a currency crisis, there's expiration on cash. So from there, in this currency crisis, junk silver, gold, and as Luke said, Bitcoin, because we can't transfer gold and silver. We just can't do it yet, right? So that's the reason why perhaps a cryptocurrency like Bitcoin and a gold-backed crypto. And I'm still trying to find that perfect gold-backed crypto. I have one in mind. You will surely know about it. So these are the things that I keep my eye on, as far as financial instruments to kind of get through these transitions, these crises and things like that. I mean, you want the cash, you want the junk silver, especially if you're in the States, because that's the first thing people are going to recognize once there's a fiat crisis. They're going to recognize quarters, dimes, half dollars, and then you got to share with them a little bit of knowledge how there's 90% silver in these things, and then gold, silver, Bitcoin, because we have to have a way to transact. And that's what Bitcoin does, and then eventually a gold-backed crypto. So these are just my opinions. It's the way I kind of see things, how they will how they're going to sort of manifest itself, and how we have to roll with it. So those are my opinions. So I just want to take a look at your comments out there. Let's see. Okay. Vintage Libra, not a bad idea. And if you have a craving for that cup of coffee, you can always sell your ounce for fiat and buy a couple cups of your favorite Joe. Okay. Let's see. Victor Claudio, the BS about silver being an industrial metal makes me sick. How should I take this? Is it because it's an investment metal, it's money, or just silver is not altogether there for you? Good comment though. Be fair about it. See what you mean by it, and it is a good comment. But silver, it is heavily used in industrial items, solar panels, especially in medical items. They, because of the the qualities it has with bacterias and viruses and things like that. Um, so let's see what else is out there. Um, let's see. Cluster of Carcosa. The whole point is to not transfer metals. I'll take pay in silver and gold. The government will be screwed when it happens in mass. Yeah, you know, but again, this is why I'm looking for some type of gold backed, where you absolutely know that what your transfer or whatever you're using does have a gold backing, maybe even a silver backing. I think David Morgan is tied in with load. But I think if we have these things, um, we know the gold and silver is safe. We know it's real. We know it's there, and then we can transact against the gold and silver, or maybe even at some point we might want to take delivery of that gold and silver. I think when we get to that area, I think that will that can help or get people to be a bit more confident once we reach that place. And I do think it's going to come. It's going to come soon. So let's see what else is out there. Anna, the faith is lost. All people rush to seize gold. The only reality left. Banks, great banking systems, governments do it and compete with people. This is the financial crisis. Garrett, 1930. It's a good point. That's a good point. Mark Burbo, Martin Armstrong. U.S. dollar is king until at least 2021. You know, I'd agree with that. It is king. It is. You know, you can't run away from that. It is today. But you know, when a currency crisis comes in, you know, as they say, all bets are off. You know, and you know, it's going to be a different ball game then, for sure, for sure. Mikhail Kalishnikov, great name. Love me some junk. Yeah, junk silver. There's some of my favorite items as well. But I want to get into the last item where, you know, all this money printing going on, you know, a lot of people will say because it's just not tied into gold anymore. It's not backed by gold. We removed silver a long time ago. The money is debased. It's just fiat. So I want to get into one article. This is lessons from the London gold pool. I think a lot of you guys are familiar with the London gold pool. If not, we'll go through this. So this is lessons from the London gold pool from goldeagle.com, written by Philip Judge, 2001. 2001. So money is the result of the function of the free market. And you guys have mentioned that. So absolutely correct. As long as man has traded his goods and services in the marketplace, money, or a medium of exchange, has always emerged as a result of this free market process. Almost without exception, gold and silver have always appeared as the free market money of choice. No other form of money has functioned as well or as long as the precious metals. Gold, reserved for larger transactions and international trade, and silver, the money of everyday trade, have emerged naturally and not as the result of some government or ruler's decree. But government has always intervened. As long as money has existed, the rulers of governments of the day have entered and become deeply involved in this free market process in an attempt to control, manipulate, ultimately debase money and the process of its issuance. Often we observe these rulers of the day working closely with money changers or bankers to achieve this end. Ultimately, government intervention has led to the ruin of entire empires and economies, along with the government issued and controlled money. Free market always wins. So let's go down a bit. London gold market, US dollar era, Bretton Woods. A lot of us know that. $40 gold. And we continue on to the London gold pool. So President Kennedy was inaugurated, sorry about that, January 61. Throughout that year, reports circulated of government and banks formulating policy and safeguards to prevent future price rises. U.S. had made it clear that it wanted to stop the drain of its own gold reserves. Okay, stop the drain of the reserves. Newly appointed Undersecretary of the Treasury Robert Russa and officials of the Federal Reserve suggested that the U.S., the Bank of England, and the central banks of the West, Germany, France, Switzerland, Italy, Belgium, and Netherlands, and Luxembourg, should set up a sales consortium to prevent the market price of gold from exceeding $35.20 per ounce. So let's go through that again. They wanted to prevent the market price of gold from exceeding $35.20 an ounce. So, under the London Gold Pool arrangement, member banks provided a quota of gold into a central pool, with the Federal Reserve matching the combined contributions on a 1-to-1 basis. During a time of rising prices, the Bank of England, the agent, could draw on the gold from the pool and sell it into the market to cap or lower prices, flood gold into the market. In the fall of 61, London gold prices again began to creep up. In November, with the scheme now up and running, prices were once more stabilized in the 35-20 range. February of 62, the gold pool was buying gold as the price dipped and selling as the price rose. So they're already manipulating the price of gold. This pattern continued over the next few years, somewhat stabilizing London gold prices despite extraordinary demand during the Cuban crisis and as a result of increasing tensions between Washington and Moscow. And then things started to get a bit dicey. So 65, the gold pool was consistently supplying more gold to cap prices than it was winning back. The beginning of the end of the London gold pool was the devaluation of the pound sterling in 67, causing yet another run to gold. Through December of that year, London sold close to 20 times its natural amount of gold at market. Under pressure from the pool, both London and Zurich ceased the sale of forward gold. In a matter of weeks, the pool had laid out in excess of 1,000 tons, in those days valued at the not insignificant amount of over 1.1 billion. And then we had France, led by outspoken Charles de Gaulle and its fiery economist Jacques Rueff, withdrew from the pool and confirmed their position to send dollars earned by exporting to the U.S. back in demand for U.S. gold rather than U.S. Treasury debt. France wanted their gold. At this point, the drain on the U.S. gold became acute. Escalation in the Vietnam War in early 68 brought renewed pressure on the dollar, with the U.S. now running massive balance of payment deficits in the world. As in all of history during a crisis, gold was again on center stage. Demand was skyrocketing. Basically, gold also helped the money printing stay in check. And, it when they tried to manipulate the price of gold, the free market took over. The free market wanted more gold, more gold, more gold. Banks couldn't keep up. They had to forego the London Gold Pool project of sorts. And in essence, it rolled over to where in 71, Nixon had to take the U.S. off the gold standard. And here we are today. Today we're in a place where the Federal Reserve is freely printing as much money or currency as they want. And that can only come with the government. The Treasury has to issue bonds or give the Fed collateral. So what is the Treasury giving away? I think it's going to be a heartache when we really find out all of what the Fed gave away. So let me take a look at your comments, and then I'll finish out with my commentary. Let's see what else is here. Let's see. Built for tough sounds sounds like the comics. Hey, you know what? That's a great point, because what evolved as well after the London Gold Pool were the paper market, the ETFs, paper gold, paper silver. It's almost like London Gold Pool 2.0. I mean, I could be wrong in giving that analysis to it, but the paper market started after London Gold Pool failed. So, it's like they tried again. They tried again to do what the London Gold Pool was doing. But the problem London Gold Pool had was they had to provide the physical gold and they couldn't keep up with it. You look at comics, I think most of us know that what they say is being traded is it's not really there. It's just paper. It's probably not the actual physical gold. So they learned their lesson from what happened with London Gold Pool. So anyway, great question. Hope I explained that well. Hostel of Carcosa, I'm always finding myself looking at your comments. Printers go brrrr. Yes, they do. Has a massive confidence limit. Yeah, it's going to reach that point. Wile E. Coyote off the cliff and about to look down. Yeah, it's getting to that point. We all are going to lose confidence in our fiat, and I think it's not just the U.S. dollar. It may start with the U.S. dollar, but it is going to trickle to probably every currency, and that's it's going to be an incredible time. So, in my opinion, it doesn't matter anymore if you hear the Fed is buying up only 1 or 5 or 10%, whatever percentage of the market, because this would be the final nail in the coffin for capitalism. And I think we all know one of the things causing the death of capitalism when we go way back was crony capitalism. I mean, you remember that word, right? It was a big word 5, 10 years ago. We all heard it. That was probably one of the bigger things that brought us to where we are today. But combine that with government and central bank intervention, and the whole of humankind is now at risk. The whole of humankind. Now, it sounds like an overstatement, but with over 30 million in the U.S. out of work and needing government relief, humankind, it is at risk. And it's not an overstatement, but an understatement. And I'll say that because we're not even counting global numbers yet. We're not even counting Asia. We're not even counting Europe. So I don't think it's an overstatement. And this crony capitalism, it cannot happen unless you have career politicians who are brought or who are bought and wheel and deal the flag of whatever country they belong to and the generations that will belong to that flag. And I don't think this is just, as I say, U.S. thing. Central bank intervention probably can only happen when career politicians kick the can down the road. And now we're even seeing the central bank kicking the can down the road, start to give free things, services, benefits, push payments so far down the road that only a Ponzi scheme will keep a dead system alive. So with the Fed in the corporate bond market, it's just a matter of time, if not already, they will be in the equities markets. And we've been talking about the government, the Fed. They're deciding which companies are going to make it, which are going to be on life support, and basically which companies are going to be dead and buried. And if what the Fed brought or what the Fed bought starts to lose money, it wouldn't take long before you see Uncle Jerome sticking his non-invisible hand into the markets and thus the economy. So much for the invisible hand, right? And let me see. So, in the spirit of what last week's guest Luke Groman pointed out, gold and Bitcoin are two forms of money, of currency, that will probably play a role to get us through the death of the old monetary system and through the birth of the new monetary system. It's that transition that we always talk about, right? That is the key part, the transition. So as I've said before, it's about having the right and various forms or money or currency to get through the transition. Gold and silver. Gold and silver are stores of wealth to transport your wealth wherever the powers that be may take us. And so again, in understanding gold and silver, it's understanding it's more than just price. It's a lot more than that. It's your insurance, it's your wealth transfer, it's your store of wealth. And if you do consider storing outside of your jurisdiction, because as I say, if you're living in a place where you feel, you have to do this, is where you're living is it going to be more stable, or do you see it being more chaotic? And it's pretty much just those two. If you see it being stable, you're in a good place. Um, Me personally, I see Singapore as being pretty stable. But if you're in a place where it seems like it may get chaotic, you may have to start looking at the idea of, should I really be keeping all my assets here? Because we do hear a lot of guests tell us, it's not just about diversifying your assets, it's also about diversifying the location of your assets. So do think about it. At least think about it. Maybe even give us a call, talk to us. We can kind of let you know what these things are like, why people do it, if it fits what you're looking at, or your situation. So by all means, you can contact us about this. Let me just put in our email address. Okay. So I mean, you can contact us, sales at silverbullion.com.sg. So take a look at a few more of your comments, and then I'll be heading out. Um, let's see. Rolf Steiner. It's the people in charge that are failing or succeeding. True. Depends on how you look at it. Yeah. Yeah. But corruption, dishonesty, and treasonous behavior usually destroys. Oh, I lost the last word. Sorry about that. Okay. Sorry about that. I lost the last word. Um, let's see. Um, okay, a couple more comments. Let's see. Okay, looks like you guys had a lot to say today. Wish I could have jumped in more. You had a lot of good conversations going on. Built for tough, yes. Silver makes you sleep good at night. Absolutely, absolutely. So again, this is something where you know I think for the most part we can say we're all in the same boat together. We're looking at things what governments are trying to do, central banks are trying to do, and you know some of it, it's okay. Some of it, it's okay for us. Some of it doesn't sit okay with us. So you know, but I think in the most part we are in the same boat where we do understand that financially things are going to happen that we've never seen before. And again, for these reasons, I do hope that you're moving into things like gold and silver. I do hope that you are considering moving over your 401k into a precious metals IRA. I mean, stock markets went down, but they've come back up. So maybe it's another chance, or another time for you to revisit the thought of rolling over your 401k into a precious metals IRA. What I'm saying, it's just thoughts, it's just opinions, it's not professional advice or otherwise. So just know that disclaimer, okay? I'm not trying to tell you guys what to do, but I'm just throwing things out there that maybe different options that you might want to look at and consider. So okay, I think we'll be wrapping up here. Just taking a look at a few more comments. Lord Humongous, yes, silver to gold ratio is starting to fall. In fact, maybe we'll go ahead and take a look at that one more time before we head out. Let me go ahead and share the screen with you guys. So we're seeing silver at, where'd it go? 1728. Gold 1762. So far so good. Looks like they're doing pretty good. Pretty good. And I hope you all do pretty good. I hope you all do more than pretty good. Stay safe, stay well, take care of yourself and the people around you, because you being healthy is what's going to help other people to get along with, or get through what's coming about. Try your best to be a blessing, not a burden. We're going to have to help people. There's no getting around that, and we're going to have to help people. And let's just be thankful that we've all woken up to see what's going on around us, and we try to do our best to help others understand. So again, I appreciate your comments, because your comments are what is going to help other people decide if they should make a phone call, make an email if they should find out more about gold and silver. So again, I appreciate that, and I thank you guys for that. So with that, I'm gonna be wrapping up. I appreciate you guys being here, spending some time with me. Actually, an hour and a half, quite a bit of time. But you just take care, and we'll definitely surely see you guys next week. And until then, saddle up for what's coming ahead and silver up. We'll see you next week. Take care.